Hey, what's up, guys? John here. The real estate market is going through a massive change, and this change is happening what feels like overnight. A 30-year fixed rate mortgage, if you have a 698 credit score, it's a whopping 7.225% for a 30-year fix. Now, I know what you're saying. John, there's no way. I see ads and I see anchors, news anchors talking all the time that mortgage rates are in the fives or in the low sixes. No, that is, in fact, true. If you have a 760 credit score, if you have really strong income, great qualifications, you might be able to get something in the mid sixes. You're not getting anything in the fives anymore, though. That is for sure. That is out the window. Just 12 months ago, you get a 30-year fixed rate mortgage for 3%. 3%. But what has happened over the last 12 months? Well, many things. What I think is one of the key caveats to all this change is we're seeing all that perceived wealth that Americans thought they had in the stock market getting pulled out. We're seeing home values starting to come down. We are starting to see insurance prices going up, property taxes going up, everything is going up. And we're starting to see massive layoffs starting to occur across all industries. I believe what we are going to start to see is opportunities for real estate investors, smart and savvy investors, to run out there and buy distressed deals, because those deals are going to be coming very, very soon. Before I dive into it and lay out all the data and the facts, please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people about what's going on. If you want to fix your credit score, you want to learn about real estate investing, again, the YouTube grind, visit cashnow.video. Now take a look at this. As mortgage rates climb, loan demand for refis drop. The Fed has decided the U.S. will need a growth recession. I love these buzzwords, these keywords, to rein in inflation. Here's why it's bad news for job seekers, right? Mortgage bracing for another 3/4 point hike. They're basing an 82% probability on this hike coming at this upcoming Fed meeting, meaning rates are going to be going higher. So the average credit score is 698, right? 698. So if you have a 698 credit score, you're at 7.225%. If you have a 700 to 719 credit score, it's 6.97%, so touching 700 or 7%. If you have a 740 credit score, you're in the top credit scores. You're looking at 6.3%, 6.3%, substantial. And if you have credit in the 640s or lower, that's why credit is so important when you step into these environments. People don't, I think, understand just how important having great credit is when it comes to this moment. Because what's going to happen is banks are really going to tighten up on their lending restrictions and only lend money to people that they deem as lower risk. If you have bad credit, they deem you as higher risk, right? Why did we see what we saw in 2008, which is you needed 720, 740 credit scores, 20% down. They were very, very tight. It's because they just took a bloodbath. They just got wiped out. A lot of these banks really lost a ton of money by lending to the wrong borrowers, right? And they're not going to want to make those mistakes again. Homeowners lose wealth as rising interest rates weigh on home values. Now, what I find fascinating here is how fast sellers are slashing home prices in America's 97 biggest housing markets. Now, they're saying that homes, on average, appreciated 43% in the last 2 years. 43% in the last 2 years. However, Goldman Sachs is predicting that homes are going to go up between 1.8% and 2.4%. And some of these other specialists are saying that no, there's going to be a 10 to 15% decline. So even if it is a 10 to 15% decline, are they really saying that we are going to see only 30% of the gains given back over the last 2 years? And the net result of this is that mortgage rates essentially went up by 100%, and we're stepping into all this financial instability in this country? I don't think so. I think that's very, very unlikely. I think what's going to ultimately happen here is we are going to really see private equity firms look at this as an opportunity to invest. Now, look at Blackstone. They pulled out of 80% of their markets that they are buying single-family homes in over the last month. Why would they do such a thing? Founder of Invitation Homes owns about 80, 90,000 houses that they founded in 2009 when the market crashed. Home Partners of America, they just bought they had 17,000 houses. They paid $6.3 billion in cash for it about a year ago. Why would they not go out there and buy now if they thought that homes are going to become and remain stable, or stay within a scope of 5 or 10%? Why would they? It's because they believe, in my opinion, they believe that Americans are to the teeth in debt. They're not going to be able to withstand this economic shock. And at that point in time, when Americans are really on their knees financially, they're going to back up that dump truck of cash all throughout America and buy up distressed affordable housing. That's what I think is going to happen, right? So when we look at this, why would they buy affordable housing? They would buy it because if The average rental in America is $2,000 a month, and they can go buy these properties for 250, 300, 350, even 400 grand and buy them in bulk. What's ultimately going to happen is the land value plus the cost to rebuild those properties in this inflationary environment, including labor cost, they're going to have a huge discount to replacement value on that purchase that they are going to position themselves well in almost any economic market, right? Whether we're in a good market or a bad market, people are going to need affordable housing, especially nowadays. And they believe that affordable housing is going to become more affordable for them to wait just a little bit longer. Look at this. Even if you have a great credit score, I mean exceptional, you are 740, right? 740 credit score. If you have a 6.3% mortgage, right? We'll call it a 6.5% because this is top credit score. This would then mean that your payment will be $3,154 on a $500,000 purchase with 20% down, right? $500,000 purchase 2 years ago, 3 years ago would have been a really, nice house. Nowadays the average median price home in America is $439,000. So this is almost like a median price home in America, believe it or not, nowadays. $3,154. That very property was $2,300 on a 3% mortgage last year, right? The difference is a cost basis of 45% in additional cost to enter that house. 45% higher cost at the same exact time as people are stepping into food inflation, inflationary environments on their business. All of this change, how are we only going to give back 10 or 15% of home values, which is only 20 or 25% price appreciation that we've seen of the last 2 years? I don't think it's possible. I think that what we are going to see is a real wake-up call because America was sold a narrative the last couple of years. This narrative is that the real enemy here is inflation. And the only way to beat inflation, to preserve and protect your finances, is to borrow money at cheap rates and to buy as many hard assets as you possibly can to hedge against inflation. Because, hey, if inflation is 8% or 10% or 20% or whatever number you believe, and you could borrow money at 3%, why wouldn't you borrow the money and profit the spread, right? A lot of people are like, yeah, that's the move. But they're buying these properties, especially commercial properties, on 3-year, 5-year, 7-year terms. They're buying these properties, and then as they're buying it, taxes, the maintenance, repairs, insurance, everything is going up during this holding period. And with it, interest rates are going to be rising, which is going to mean it's going to be very problematic for a lot of these investors to refinance their properties down the road if, in fact, mortgage rates do not decline. As of now, what we're seeing is a 15-year high in adjustable rate mortgages because people are very desperate to get into a property. At least they were a few months ago. And because of it, they're like, you know what? If I go from a 30-year fixed rate at 6.5% or 7%, I can go adjustable. If I go adjustable, then maybe I can get into the deal at 5.6% or 6%. And a lot of people are doing that. They're running out there saying, you know what, now's the time to get that adjustable rate mortgage. And then in a year, 2 years, or 3 years, I can refinance it into a more affordable product. But if in fact that does not happen, if rates do not come down, we're going to see a wave of home buyers that made a very, very big mistake. I would not suggest gambling or betting that something is going to happen in the future just because it happened in the past. What I'm looking at in our future is something that is going to rewrite history. We're not witnessing, some things that we've seen in the past. We're witnessing a whole new economy. We're witnessing massive change coming very, very soon. It's up to the smart and savvy investor to take advantage of it. What do you think about this entire situation? Mortgage rates, 698 credit score, 7.225%. What do you think about it? Where do you see rates going by the end of the year? We have a hike coming at the end of September, and we have some more Fed meetings to come very, very soon. Do you think we're going to see mortgage rates hit 8% for this borrower, for this demographic of 698 credit score in the next few months? Drop your comments below, hit the like button, subscribe also on my second channel if you are interested in personal finance, real estate, business, and money. I'm interviewing some really great hosts. It's the call-in show is happening. A lot is going on over there. Be sure to subscribe there. And LinkedIn, Twitter, Instagram, and TikTok. If you want to fix your credit, you want to learn about real estate investing or get on the YouTube grind, go to Cash Not a Video. And if you want to be an affiliate with Cash Not a Video, maybe you are in real estate, you are a mortgage lender, or you're in solar sales, you are dealing direct with consumer. And that consumer needs good credit to buy your product or service. Join as an affiliate, and there's a lot of perks and benefits to your business, as well as monthly recurring passive income. I'll catch you guys in the next video.